Good morning. Welcome, everyone. It is half an hour before the market opens on February 13th, Tuesday. And the big item that we've been waiting for is that CPI report. That's the one that had the big potential to really move the markets and send us in one direction or another. So we'll see how that print came out and how it's shaping the market so far, and then how it might influence the market during the regular session. So let's go ahead and take a look at our futures. Oh, and we are down really significantly. I haven't seen a market go down this much in the pre-market in, I don't even remember, maybe at least a few years, maybe as far back as COVID. COVID was worse than this, but this is a lot. We got our S&P down like 1.2, 1.3%, and our Nasdaq is down 1.8%, and our Dow Jones is down about 1%. So that is really, really significant. And well, it just flipped a little bit lower, so about 0.9%. So that is extremely significant. That's a huge gap down in terms of an index. For an index to gap down about over 1% overnight is pretty significant. That means there's basically zero chance that we're going to end up at a new high for today. We're definitely on our way down. We may bounce and recover some, but we're not going to recover all the way up to the previous day close. That would be pretty miraculous. That would be really, really amazing to see if that actually happened. But the chances of that are very, very, very low. So let's see how this CPI report came out, and then actually let's see what the reaction of the market was first. See if how much of this was due to the report and how much of it was already in, because the report, to send it that far is unlikely. So most likely we came down at least a little bit, and then the report sent us lower. And let's see, I can't even. Okay, so here is our close over here. So overnight in the pre or post market session, we did trade a little bit lower, but mostly sideways after the initial movement lower. And then in the pre-market session, morning session, we started to trade even lower. And then we had that huge drop because of that CPI report. Let's take a look at our bonds, see how that played out. Actually, so bonds was actually heading higher this morning. And then we got the shock of that report that sent us way lower. So bonds being down this much, this is, well, we'll see if that broke that horizontal line that we were looking, that support that we were looking at. If we broke that, that's not great news for the indices. That's a good indication that we're going to start heading lower. So we'll take a look at our TLT. Yeah, so this is the purple line right here is the one that I was talking about, that support. And looks like we're going to open below that support. So as long as we don't trade up and above it during the session, that is pretty dire news for the QQQ in particular. And we saw in our futures that our QQQ is down the most. The Dow was only about 1%, not quite 1%. The S&P was like 1.2%, and the Nasdaq was down 1.8%. So it's hitting the Nasdaq a lot harder. And that was to be expected, because this bond market, as it comes down, then yields are higher, and that starts to compete with growth stocks like the ones that we tend to find in the QQQ. So let's take a look at that actual report. I'm still not used to this calendar. CPI forecast at 309. Yeah, that's not too helpful. Where's my, there we go. CPI. Okay, so previously core CPI year on year was at 3.9. Everyone believed that it was going down because that's a lot of indicators were saying that the inflation was coming down. That's why we had a lot of enthusiasm for rate cuts in January and going forward. And the market was expecting 6 rate cuts, even though the Fed was saying 3. And now, because we actually didn't change, so actually inflation hasn't come down, but it hasn't even increased either. So it's not super bad news for the Fed. It just means that it's unlikely that we're going to get rate cuts anytime soon. So the market is not liking that because we're pricing in 6. And what did we say? That if we were going to get 6, then we would have to cut every single meeting going forward for the rest of the year. And it's looking less likely that that's going to happen in March. So let's take a look. March or May, sorry, May. It's less likely to happen in March, less likely to happen in May. So over here, a week ago, we were still expecting a 19% chance, or a month ago, it was 77% chance that we were going to get a rate cut in March. And now we're down to only 6.5%. And if we look at May, yesterday we were looking at, it was like 53%. And now we're only looking at 36%. I guess if we add these, right, we have to add this also, but I don't have that. Oh, I do have that number. So yesterday we were looking at over 60% chance of a rate cut in May. And now we're only looking at about a 38%. And I think I said earlier that I was expecting this to be about 30-40%. And here we are. We're at right in between 30 and 40%. Based on today's CPI number, that's probably going to go even lower. And then we've got June, July, September, November, December, 1, 4, 5, right? So if we don't cut in May, then we only could, at maximum, we could only cut 5 times. So that is probably why we have such a large reaction to that CPI report today. Now that we have the CPI out and we already have a large reaction to it, Friday's numbers become a little less relevant. So CPI is always a really big report when we are in an inflationary environment and trying to figure out what the Fed is going to do. It's like as important as the reports come. It's like a 9 or 10 on a scale of 1 to 10. PPI would be like a 7 or an 8. And consumer sentiment is always relevant in terms of GDP. But now that we've got this big reaction to the CPI report, this is, I mean, what is PPI going to say? Like, even PPI is like, it's amazing. Like, we're prices are coming way down. Everyone's going to be like, yeah, maybe for companies, but not for the consumer. And what we're concerned about is the consumer. So these reports become a lot less relevant. This is going to drive markets for probably the next few days at the very least, if not even further down the road. So what does that mean in terms of our major indices and the trends that they were in? You can see this gap down that in the pre-market, this is really messy because we drew all these lines yesterday. Let me remove all of them and draw a new trend line. I guess I shouldn't have removed all of them, but because I want to keep these implied moves from before, so I'm going to have to delete these individually. Here we are today on Tuesday, and we're gapping all the way down to right here. So that is just above the trend line that we drew and just above the EMA 20. So if I move this temporarily, you can see that EMA 20 is right there. So we're gapping below the EMA 8. What we want to see is, what direction do we trade in today? Are we going to start filling the gap? in which case we will probably bump into the EMA 8 and have difficulty going above it? Or are we going to go down towards the EMA 20, in which case we'll probably get stopped by the EMA 20 and have difficulty going down below it? And then we'll wait for the rest of the week to see which one of those two we break. Do we break to the upside or we break to the downside? If we break to the downside, then we're starting to get into the more significant pullback territory, and it becomes a lot more likely that we hit that MA50. And we saw clues of this yesterday with the VIX. Remember, I was saying that, hey, it's really weird that we keep making these new highs, or at the very least going sideways, but our VIX is jumping up. We said that, yes, this is today's VIX. So VIX today is probably going to start spiking, is already moving upward, as you can see. And then TLT, if we come down and we start trading downwards even more, then that is going to be a strong indicator that most likely we're going to be tracing back to that MA50. So if we do that, let's go from the high at the close. So the MA50 as of yesterday, then that would be down 5.26%. So today the MA50 should go up a tiny bit. So we're probably looking at around 5%. So a 5% pullback, that's nice and healthy. We'll see if that MA50 holds. And if it does, then we can bounce back. We can go higher. We could go to that. I guess I already deleted it. Oh, man, what just happened? I don't know what I just did. Okay, so if we hit that MA50, then we could go up to that second psychological point where I said that was the 25% move up from this low right here. And then maybe we'll see. I don't know if that's enough to put enough cash back into the market makers' hands for them to continue to drive it higher. We'll just have to wait and see how all of that plays out. So for today, just expect a lot of volatility, especially in that first hour. I'd be very, very careful. And look, we were undoing so many days of upward movement. If we go over here, it's a 1, 2, 3, 4 weeks worth of upward movement just on the open. So a lot of volatility. We could head higher. That's the tendency at the opens to head higher towards the previous day close. But there's a lot of places we could get stuck on the way up because we gap down below so many of these lines. The strongest one would be the VWAP, which is not that far above where we are right now. It's two of these lines above. So upside potential today is not great, even from where the open is. So basically what I'm saying is the potential for a green bar today is low. It's possible, but it's low. Potential for us to close above the previous close and continue the uptrend is extremely low. I would call it almost zero. But there's good potential for us to float somewhere in between the EMA 20 and the EMA 8. And then in Wednesday, Thursday, most likely Wednesday, Thursday, maybe Friday, we'll challenge one of those two moving averages, and then we'll see if we break through either one of those. A little bit of excitement today. We could potentially see some directionality move out of this. Well, this is definitely the directionality. What I mean by that is either the break or holding of this trend that we're in. It's looking like that decision will be made again either sometime this week or early next week. So we came in touched right here. The answer was we bounce and go higher. We came in touched again. The answer was we bounce and go higher. And so we're probably going to touch again in the next 3 to 5 trading sessions. So nothing else is going to be that relevant. We do have earnings. Let's see if there's any. We already looked at these. Coca-Cola. but as a staple, it may get some attention, actually. It may get quite a bit of attention because it's a safety stock. And if they have good earnings, then people could pile into it even more. Let's see if they released. Yeah, so they're already, it's looking like they're going to gap up right here. So that's interesting because with the markets gapping down so much, Coca-Cola is gapping up, and that could be a combination of earnings and money preparing to move into a safer stock. So Coca-Cola might get quite a bit of attention today. And today after market, Airbnb, that will reflect quite a bit on consumer discretionary. So even if they have great earnings, they might get money sucked away from them today. Same with MGM. And then tomorrow before market. But those are probably the more interesting ones. So I would expect earnings to help us in this situation. CPI report is going to suck in all the attention, and it's going to be the major driver, at least for a couple of sessions, probably at least to the end of this week, since this PPI report has suddenly become less important because of the big reaction in. So be careful today if you're day trading. There could be some wild swings, lots of bull traps, bear traps. Expect an expanded range of trading today. Expect volatility to kick up. And then hopefully your hedges are fresh and they're helping you quite a bit today. My hedge, I should have refreshed at the end of last week. It's something that you want to look at every week just to make sure that the protection that you're getting in proportion to the move that you're anticipating is still in place. And for something like QQQ, right, if you're indexing off of, hey, I think it might pull back to the MA50, and that MA50 keeps moving up, then the protection that you're getting because you have a static strike price is less and less. So that's something that you want to be aware of when you're looking at your hedges. And I didn't look at it. So we'll see how well my particular hedge protects my portfolios. But at the very least, it provides some protection. It's not going to be zero. It's not going to be nothing. So it's good to have those hedges in place. And of course, if you have pairs paired up, then it doesn't matter. The one will protect from the other, no matter which direction it goes or how much, because they're relative to each other. It's not relative to, say, a moving average that keeps moving. So we'll get ready for the market open. Just expect a lot of volatility in the first hour, and I would avoid trading in the first hour. And then we'll see how the day plays out, and then I will see you in the aftermarket session. See you guys.